What's an ESOP? An employee stock option plan. I'm Bob DePasquale from Initiate Impact Virtual Family Offices. Today, we're talking about ESOPs, or employee stock option plans, and it's some of the basics so you can understand about your own retirement plan at work. In the United States, there's an estimated 14 million participants in ESOPs. Wow, that's a lot of people. The stock you receive in an ESOP is typically company stock from your C corporation or S corporation as your employer. It's typically a privately held business, not a public corporation, that has this, and it's a great way for owners to exit the business. And the benefits are usually very good for the corporation, the owner, and the people taking it over. Generally, shares of stock accrue over time and they may be bought back by the company for cash upon your retirement. Here's a couple things you're going to want to know. Number one, they usually have vesting schedules, and there's two different types. The first is a cliff vesting schedule where you'll start with 0% ownership of the employer contributions. And over a 5-year period, it will increase by 20% until you are at 100% of vesting. The second is a graded vesting schedule, and then over the years of your plan, participation, and employment, you'll increase the value. This encourages continuity of employment. The second point is dividend distributions. If it's a C Corp, those dividend distributions will still be considered income, but not a early distribution like a typical retirement plan where you would receive a 10% penalty prior to age 59 and a half. You can potentially reinvest those dividends back into the plan if you don't want to take them as income, and those dividends are then considered 100% vested. Third thing to consider is the stock price. It must be calculated by an independent firm on an annual basis. Fourth thing is ESOP participants have diversification rights as long as they've had 10 years of service and are at least 55 years old. At that point, you're allowed to diversify 25% or 50% if you've reached age 60. At no point can it be more diversified than that 50%. Distributions will begin at a normal retirement age, which is typically age 65, or your 5th year of participation in the plan, whichever is later. Tax treatment for these gains is excellent. The contributions, you don't pay taxes on those. And when you pull them out, they're typically taxed at long-term capital gain rates and not regular income. And as an employee owner, you have the ability to affect management decisions for the company. That's a nice benefit too. And if your company has an ESOP, you may also have other retirement options like a 401k. So look into that for other options to help you save for later. There are a couple things to consider drawbacks to ESOP plans. One of them would be diversification. You're putting all of your eggs in one basket. Your savings and your retirement income is based solely on that company. And the other thing is your ownership percentage will decrease as the company grows. As more employees come in and more are owners, you don't own quite as much of the company anymore. As mentioned in the beginning, these plans can be very complicated, so you want to check with your human resources department and collect all relevant documents, specifically the plan document. That way you can understand what it's all about. And if you need assistance, please contact us or your financial planner. Once again, I'm Bob DePasquale with Initiate Impact, where we love helping people with these type of things so that they can be more generous. Wishing you a generous week. Talk to you next time.